Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. And, I think it's been a few Fridays, and every Friday we've been saying, thank God it's Friday, and really thank God it's Friday. Just a brutal session last night. And I think we will at least feel some of it here as we open up for trade. We are coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleague Surabhi and Mangalam is with us today. Guys, hi, morning.
Morning. You call it a Freaky Friday? Is that what you're going with today?
No. Let's just say thank God it's Friday. We've had enough of freakiness on Thursday. I think maybe Nigel just couldn't take the Trump tamasha, beyond a point. I think that's why today he sent in Mangalam. But
the good part is that we're down, not out yet. Let's see where we go from here on itself. Because from everything that's come by, it seems like maybe we aren't as hurt as some of the others.
Absolutely. I mean, the US markets, India, the thing is India fell first.
Yes.
That's the only thing. We topped out in September, October last year. US was rallying, making newer highs all of this year. And it's just started falling. So it's kind of, there is that element, lead lag always happens. And especially true because India and the US, as I've said many times, two best performing large markets, outshining everything else over the last 3-4 years, tightly correlated. All right, well, let's take it from the top, right, in terms of the action. So aftermath of Trump's tariffs, ugly, really ugly, no other way to put it. The changes are on your screen. S&P down 5%. Actually, we knew yesterday while we were trading, US futures were down, not 6 on the NASDAQ, but on the S&P, we had a 3.5, it's 1.4% cut. So we kind of got the trailer while we were sort of trading in our session during Asia. And if anything, losses accentuated. The Russell lost about 6.5% in terms of value. It's the worst day for US equities since 2020, I think June of 2020. Basically, got to go back to COVID kind of days to find these kind of changes on a day-on-day basis. Wix jumped almost 40%, back to about 30. The vibe kind of, in a way, is essentially a bit of a recessionary kind of market tried to trade that, in many macro markets, especially the 10-year yield, 10 basis points shaved off. We're about 4%. Now there are calls of under 4%, 3.5%. We'll see. Oil prices, big 7% cut, about just under $70. But with oil, of course, it started with tariffs. But then there was also additional information that OPEC Plus is increasing supply of oil in the month of May, I think, by almost 3x what they earlier said they would. This is daily supply in the market. So there was that additional oil supply, along with, of course, growth fears, which contributed to the 7% fall. Dollar index, we are back at about 102. I think this is essentially where the dollar was, the broad dollar was before Trump took charge. So you're back to pre-election kind of levels here. So this is, of course, all largely driven by the Trump tariff and what he's done. But there was also weaker data, so that complicated matters further. Especially the ISM services number was a miss. And here, the employment component, it fell to the lowest since the last couple of years. And I think this, as I said, did not help at the margin because the fear is things are going to slow down pretty fast. And the fact that you already have some of these data points showing you, and services is sticky, much more sticky, showing, stagflationary kind of indications. I think this is not good. Later tonight, just to kind of sort of complete the data picture, you get the jobs number, which is the monthly number, which is the big one. And you also have Fed chair who will be sort of speaking, not on the jobs data, but he so happens to be speaking after the jobs number will come out, which will be around US market opening time. And we'll see if he has something to say about the data, of course, and of course tariffs as well. Some other markets, yen was up 2% against the dollar. Gold weakened. Gold was down about 1%. But I think, just if you look at last night, it's just liquidation, overall liquidation. It still is a safe haven and everything that goes with gold. There's no change in that, but it's just that it's done very, very well. I was looking at data points and I'm just putting out one. Goldman has cut their estimates for GDP growth across Asian countries. For India, it's a 0.3% cut. They're about 6.1%, which is below consensus. And of course, I'm sure others have done, and we'll get you those as well as we go along. Just to tie in the levels here, we put this out yesterday as well. Watch for the 20-day moving average for both the Nifty and the Bank Nifty to be sort of defended. 23,150 between where we are now and the 20-day, there is 23,150, 23,130, 150 is the range. But 23,150 broadly, we'll see if that is defended or not. And for the Nifty Bank as well, the graphics will come up. Support on the 20-day moving average and 49,368, which is the big one, which is the 61.8% retracement of the full bounce that we've seen from the 3rd of March low to the 25th of March high. So that's the picture. GIFT Nifty will come up on your screen, gives you a quick sense of how we're likely to start. It's a 100-point. Given the massive sell-off, it's a reasonable 100-point cut, and we'll be lucky if we just sort of get away with it by the time it rings 3:30 later today. Surabhi.
Prashant, I was looking at those growth estimates for India as well. You mentioned Goldman.
Yeah.
Morgan has cut by 30 to 60 basis points. This morning, Citi is talking about a hit of 40 to 50 basis points. So that's the rough impact that people are calculating for India if the tariffs remain at 27%. But by the way, folks, before I get to the Qs and what Asia is doing, we have to see the man after wiping out, I don't know how many trillions of dollars of global market capitalization. Let's look at, Donald Trump. This was a White House post that was put up there. He's in Friday mode. He was yesterday saying it's almost Friday, unshaken, not stirred, can you say? This man has a mind of his own for sure. So before we talk about how Asian markets are reacting, that's his almost Friday look. Breezy on the White House lawn.
The answer, my friend, is blowing in the wind.
Blowing in the wind, I think so. That's his mood.
I mean, it's a meme fest out there. I mean, with Trump, and I saw one actually. I posted one myself.
Okay.
Have you seen Gladiator?
Yeah, yes, of course.
And then the Colosseum, you have Russell Crowe is with his shield and sword. Yes. Are you not entertained?
I think this is a good idea. I think Friday last segment we should do this.
When the history of the world is written, there would be at least 10 chapters dedicated to memesters.
Oh, absolutely.
What a beautiful moment to just, what would have earlier taken 1,000 words to write an article, etc. Just one picture.
And 1,000 words and all that.
Totally. And a little more memory than that and a little more carbon footprint than that as well, given the AI generation and all of that. But really fun.
No, that's true. One good contribution of the digital world and economy. Memes. No taking away from that. Okay, now we have to get serious. Let's actually play out the sound bites because he was asked about this market rout, and Donald Trump was also asked about whether there is room for negotiation or not. Hear out what the US president said.
Well, I mean, it's to be expected. This is a patient that was very sick. We really inherited a terrible economy, as you know, with a lot of problems, including loss of manufacturing, plants closed up all over the country. We've lost 90,000 plants since NAFTA, if you think of that. 90,000. It's not even believable. And about 6 million jobs. And so it was a sick patient. It went through an operation on Liberation Day. And it's going to be a booming country, a very booming country. It's going to be amazing, actually. And we see it because we have trillions of dollars committed to come in. Trillions.
Okay, so that's the US president. And there was some back and forth because Lutnick and trade advisor Peter Navarro originally had said that this is not a back down moment at all. The US president won't back down, and there's no scope for this is not a bargaining chip. There's no scope for negotiation. But then Trump later on went to kind of deny that. He said that this would be negotiation. He's always been open to that. Anyhow, now let's look at the market impact. So what we're talking about is a big rout across Wall Street. The Magnificent Seven yesterday lost about $1 trillion in market capitalization. By the way, the Russell 2000 slipped into bear market territory. Technical definitions, 20% down from the peak. The Russell was down almost 7%. The Nasdaq obviously was down, almost 6%. Let's now talk about how Asian markets are reacting. If you thought Asia is already done with this fall, that's not the case. Look at the markets. Japan, South Korea, Australia, all these markets are down anywhere between 1% to, in fact, 2.5% on Japan. So the pain continues. It doesn't seem to be entirely over. There's also some additional news flow on China. Fitch yesterday downgraded China to A, from A+, the foreign currency rating that is. And why did they do that? Because they said the public finances in China are turning very weak. There's a lot of government debt, and that's making them a little uncertain. By the way, this rating downgrade has happened without taking into account the impact of US tariffs on China. So even without that, they've come up with a downgrade. The markets are not trading. Mainland China, Hong Kong, Taiwan, they're all closed for a local holiday. So we're not exactly getting a Chinese reaction to all of this. On the currency side, the euro and the yen are charging ahead. The dollar, the dollar index has been below 102. The dollar has been faltering, and some of these safe haven currencies, so to speak, they are moving ahead. So yeah, let's get them on the screen. You can see 1.1 euro dollar now, and the yen is now at about 146. Which brings me now back to India. Yesterday, we were relatively unscathed in the turmoil. Can that continue or not? Let's see. We'll find out the answers. The fund flow picture is continuing to be slightly grim. Yesterday, we had selling, 2,800 crores of selling. Domestic institutions were on the sidelines. Perhaps they wanted to wait it out and let the dust settle before they weighed in. In terms of stocks, one stock that will definitely be in focus, Masgao Dock. The government has decided to sell some stake. There is an OFS where about 4.83%, nearly 5% of the company's equity will be offered for sale. So that's one stock on the radar. But we have to navigate the global storm first, Mangalam.
We have to navigate the global storm, and that is something that will, reflect in the GIFT Nifty itself, the Magnificent Seven. I was just this morning trying to revise the names itself. All of them down $1 trillion in market cap, and that was something that really stood out for me from the world. But what's good part is that India is right now perhaps the cleanest shirt in the laundry. Why do I say that? Because the GIFT Nifty, despite the weakness that we've seen overnight on Wall Street, despite the weakness that we're seeing in Asia right now, is not indicating a big cut. It's down just about 102 points. Like Prashant said earlier as well, we'd be happy to take just this, given the sort of weakness that we're seeing around the world. So in light of that, the Indian markets down, but not out. If you look at the Nifty Bank, that really outperformed yesterday, up around 0.5%. The broader markets did a lot better as well, with more stocks advancing than the number of stocks which are declining itself. So we'll just keep an eye out on how that pans out. The two overnight macros which are positive for India is the way Brent fell and the way the dollar index behaved as well. This at a time when we had also seen a fair amount of rupee weakening, FII outflows, etc. So weakness in the dollar index and weakness in crude are India macro positive. Does that sustain into our markets or not is something we'll most definitely watch out for. The FIs, who started the series fairly optimistic with 40% long exposure over the last 4 trading sessions, have reduced their longs, increased their shorts, and yesterday as well sold about 1,900 crores in index futures. So if we are resilient, then maybe you can see some bit of short covering, if at all we are resilient. So that's something we'll have to watch out for. If you look at the FII long exposure, started the series with 40%, now down to about 30% itself, with shorts at around 70%. Just watching out for a couple of levels on the Nifty. Yesterday's low, extremely crucial, 23,145. Then you have the 50-day moving average at 23,000, and below that is the 20-day moving average of 22,986. So those are positive levels for our market in the sense that we are closer to support than we are to supply zones for the frontline index. The Nifty Bank itself is above the 200-day moving average. Good update coming in from HDFC Bank. Can that outperform? The sector for today could perhaps be the financials on account of the fourth quarter business updates. Short point, the global problems continue, whereas India is resilient by virtue of its own domestic-facing businesses and some of the macros that might turn in our favor.
Okay, absolutely. So let's hope that India can remain resilient. Let's kick it off then with the equity call of the morning. Surendra Goyal of Citi says that Indian exports are set to see reciprocal tariffs of 27%. However, he adds a few key export sectors like pharma, energy are currently exempt. He says for large cap listed universe, the impact from reciprocal tariffs could be concentrated in auto ancillaries, chemicals and select industrials. Surendra says IT services may have secondary impact owing to any decline in global or US GDP growth and from decision-making uncertainty as well in the near term. He adds overall impact at the index level could be modest given the relatively low share of US export revenue from these sectors in the overall India large cap universe. He says including small caps and mid caps as well as the unlisted universe, he notes that several sectors like cables and wires, chemicals, auto ancillaries, industrials operating on modest margin profile may seek to pass through tariff impact in price increase to their customers.
All right, well, this is Samiran Chakrabarti of Citi who's weighing in as well. He says the imposition of 27% reciprocal tariff on India The weighted average tariff rate on Indian exports to US stands at 25%, with 7% exports exempted from tariffs at the moment. He says, assuming tariffs sustain and all else constant, they estimate export drag could be 50 basis points of GDP and growth impact at 40 basis points. He says some factors like trade diversification and negotiations could lower the impact of a trade if a trade deal is arrived at. He says they now see 3 more 25 basis point rate cuts. Well, Mark Franklin is with us, Deputy Head of Multi-Asset Solutions Asia at Manulife Investments. Thank you very much, Mark, for joining us. Good morning. So it's a red letter day, no other way to put it, at least for US. How would you look at this? I mean, much has been sort of talked about, much ink has been spilled, lots of views out there. But let's try and look ahead, Mark. Is there any way this turns out to be good for the US? I don't know how, but you've got to ask that question in the medium term and beyond. While it's very, very red and it's a bit of a detox, I don't know if I can use that word, but what's your sense, Mark?
Yeah, good morning. Let's try and understand what the objective is here for the US administration. The objective is to try to rebuild the industrial base of the US economy, which will give it a stronger geostrategic foundation. It's also attempting to effectively bring down the fiscal deficit and the trade deficits as well. And some of the things that have already happened begin that journey. So one example is that bond yields have fallen in excess of 60 or 70 basis points since the start of the year. So that part of the fiscal expenditure, which goes on debt servicing, is already starting to come down. Whilst we don't have tangible numbers yet on the progress that the DOGE department is making, there are clearly some additional incremental progress is being made in terms of cutting government spending as well. The trade deficit is definitely going to take longer. It takes a while for domestic producers to gear up, invest, and to expand capacity. But then the final point as well is the desire to try to onshore jobs, onshore investment, and so on. And there, what is likely to happen is even if domestic production fills the gap that's being created by importers withdrawing or reducing their market share, a lot of any incremental industrial production will be automated via robotics. So it's not entirely clear that a swathe of new jobs will be created. These are all long-term objectives with some initial progress being evident. But what is unavoidable is the short-term dislocations that it will cause, not just in terms of economic activity via higher uncertainty and reduced investment and spending decisions, but also some inflationary pulses that will kick in as a result of these very elevated import tariff increments that have been introduced with immediate effect. So short-term pain inevitable, long-term gains potentially, but it's going to take a while to realize.
And the short-term pain is, really looking very painful, Mark, with the kind of immediate drawdown in markets. Just trying to understand, how you would perceive a market like India, because it's all getting very, very granular and specific now. The belief is that maybe we're relatively better off. But what would your take be?
You're right to highlight that structurally, India's economy is less open to other emerging economies globally. Domestic consumption, domestic investment, much bigger drivers. And therefore, by extension, major disruptions to global trade activity or effectively deglobalization should impact India economically and fundamentally less. That being said, though, it is an equity market, and equity markets are very much psychological in nature. And if other markets outside of India, such as the US, but also other emerging markets, see a flight of capital towards safe haven assets, India will be correlated to that as well. So it's more of a relative assessment that there is a certain degree of resilience that India has structurally, but inevitably any prolonged pressure on risk assets more globally will find its way in terms of the impact on psychology for domestic investors in India as well.
So in light of that, what would you suggest would be a good asset allocation strategy? Do you think overall there should be a reduction to equity? And if that were to happen, then where do you go? You go to bond, you go to gold. Gold is anyway on a bull run. How do you look at, asset allocation at a time like this?
it's inevitable that the focus will be predominantly on equities because there we're seeing some pretty sizable moves to the downside. But that does ignore the fact that some asset classes are doing rather well at the moment. You highlighted bonds. We've been positive for some time on the shorter end of government bond curves as a result of this repricing of growth expectations off the back of the tariff policy announcements. And then a subset of fixed income that we also really like as well is shorter dated Treasury inflation protected bonds. These give you some degree of protection should inflation start to pick up again in the coming months, but the Fed remains somewhat dovish in order to try to stabilise the economic activity outlook as well. So there are certain asset classes that are doing rather well, but of course we have to still maintain a certain degree of diversification in portfolios. You mentioned gold. We have a long-term secular positive view on gold at Manulife, but in the near term, we are starting to lock in some gains tactically because of the relative outperformance that the commodity has experienced. And the likelihood that central banks will probably pause their purchasing activity at these relatively elevated price levels. But we're looking for entry points again on gold over the medium to longer term. Certain commodities as well will be caught up inevitably in this downdraft in terms of risk appetite. But there are commodities such as copper that are going to experience some pretty profound supply deficits in the near term, which will certainly put a floor underneath pricing should there be a bit of a pullback. And we are likely to see sort of second order effects off the back of the US government policy announcements on the trade and tariff side. It's much more likely to induce economies such as China and potentially Europe as well to stimulate their own economies domestically on the fiscal side at the very least. That will have knock-on benefits for industrial metals demand, but in the near term, they will be caught up in this bout of volatility.
Mark, then finally, just quickly, equities. What is your preference? Which markets and in what order?
So if we look at sort of factors and sectors, we are quite more comfortable being exposed to the higher dividend-paying, quality dividend-paying sectors and parts of the market. Reason being that, we're a total return investor. So in an environment where capital returns are initially somewhat challenged, you have that income stream kicking, which will help to sort of provide some ballast to portfolios. In addition to that as well, we're going to have to refocus on corporate fundamentals and be positioned into those businesses that are somewhat more immune to the disruptions that are being caused by government policy initially in the US, and have the ability to pass through price increases as a result of higher import costs as well. So we're in a more selective phase of market cycles. And then from a factor point of view, perhaps pivoting more towards high dividend growth type business models.
All right. Mark, thank you very much. Good speaking with you. Appreciate you joining us and running us through what you make of things. It's a fluid situation. And there is a fair bit to track. Let me quickly tell you what the corporate interactions are that are lined up here on the program. We have at 8:35, Pralay Mondal of CSB Bank coming us to talk to us about their fourth quarter business update. 9 o'clock, Digant Haria will be talking about the business updates on the banking side, which have come through from last evening. 9:20, the CIO at Axis Mutual Fund will be our market master today. We ask markets and, of course, road ahead. 9:30, the manager of Bazaar will be with us on the auto sales numbers. We have the management of Gokuldas Exports talking to us about the apparel side and how things will pan out after the tariffs. And PG Electroplast on the EMS side, Vikas Gupta will be with us. There's the PLI, components PLI, but also, of course, the tariffs, which perhaps we'll talk to him about. And, of course, Citizens MPC, April 9th is the RBI meeting. And the MPC begins next Monday. Latha will be in conversation with experts to discuss if RBI will cut repo rates ahead of the, during the MPC meeting on the 9th of April, and what will they guide more importantly? That's the lineup.
Totally. What will they guide will be the extremely important part that we'll look at. It's time for a quick break, but we'll get stock specific on the other side. We'll get to it in just a bit in our special top 10 segment. We're looking at HDFC Bank, Avenue Supermarts, Adani, Wilmar, Bandhan Bank that are on our radar on the back of positive news flow. On the other side, we have Bajaj Finance, L&T Finance, RBL Bank, Mazagon Dock, Shipbuilders, and Angel One. Stocks that are likely to open in the red and see a neutral view on oil marketing companies.
Welcome back. So the trading cues that we're getting across from Asia are still weak. Just reminding you that the Chinese markets, Hong Kong and Taiwan, they're all shut today. But the ones that are trading, the Nikkei is down, still down over 2%, 2.3%. Singapore is also slightly lower, as is Australia. So still weak cues coming through. The implied open, let's pull it up again. It was suggesting that we'll probably start about 100 points lower. 109 points lower. So that's the sense for us. Now, what about individual stocks? There's a fair amount of news flow as well to go over. We have our team standing by with the CNBC-TV18 list of top stocks to watch. Guys, morning to all of you. A lot of banking updates came in yesterday. Abhishek, let's start with HDFC Bank.
Well, HDFC Bank has seen one of the best sequential business momentum in last 4 to 5 quarters. So take a look at the deposit growth. It's at 14% YOY and about, close to 6% quarter on quarter. This sequential growth, that is quarter on quarter growth, is one of the best that you are seeing in last 4 quarters. The CASA in absolute value grew by more than 8.2% on a sequential basis, which meant that for the first time in last many quarters, CASA ratio has improved for HDFC Bank. Now, CASA ratio has improved to 34.8% versus 34% in the previous quarter. Advances growth pretty healthy on a sequential basis. Sequential loan growth is at 4% quarter on quarter, one of the best that you are seeing in last 5 quarters. So the overall AUM growth is about 7.7% YOY and about 3.3% on a sequential basis. Calculation shows that they are on trajectory with respect to maintaining their CD ratio at a lower level. So CD ratio has declined to 97.4% when compared to 105.4% in the same quarter last year and about 99.2% in the previous quarter, in line with the guidance that they will look to lower their CD ratio. Back to you.
Right, good update coming in from HDFC Bank that should support the cause of the Nifty Bank, which is outperforming in any case. So we'll keep an eye out on that. But Abhishek, stay on. A lot of other financials also reported their fourth quarter updates. Bajaj Finance and L&T Finance. What do you make of them?
Well, Bajaj Finance, the AUM growth rate has slowed down. So it is one of the weakest that you are seeing in last 8 quarters. And sequentially, the growth is the weakest that you are seeing in last 11 quarters, although the numbers remain strong when compared to what you are seeing with the economic activity. New loans are up 36% YOY and down about 11% sequentially. This is seasonal in nature, that Q4 versus Q3, you do see, new loans declining. Customer base has grown at 21.7% YOY and about 4.8% sequentially. The AUM growth rate, that has slowed down, and that's to be seen what the management makes of it. It's now down to 26% YOY and about 4.7% sequentially. One of the negative that I have calculated from the numbers is that the cross-sell rate has declined to 5.9% versus 7.2% in the previous quarter. So cross-sell rate is one of the lowest that you are seeing in last 4 quarters and second lowest that you are seeing in last 15 quarters. Now, L&T Finance, the disbursements have remained weak despite Q4 seasonally being very strong for them. So retail disbursements are down 1.2% YOY and about 2.2% on a sequential basis. The key weakness in the disbursements are seen in farmer finance, which is down nearly 30% YOY, urban finance, which is down 6.5%. Retail loans have grown at 18.8% YOY and about 3% on a sequential basis. The disbursements to AUM ratio has declined on a sequential basis to 19.5% versus 21.4% in the previous quarter. Back to you.
Right, Abhishek, thanks a lot for that. I'm looking at Adani Wilmar as well as DMart. Both of them came up with their quarterly updates as well. For DMart, let's start with that. No real fireworks, but nothing really to worry about as well. Standalone revenue growth at around 16.6%. The total stores at 415. What's good about these numbers is that the company has added 35 stores. So the people who are, asking for DMart to increase the pace of their store addition, that's happened. Typically, fourth quarter is where they add more stores, but 35 is higher than the average that we've seen in the last few 4-quarter additions as well. But what's not is that the implied same-store sales growth, if you look at the stores last quarter, as in the last year and now, it's close to around 3% which is lower than what we've seen earlier. So the key to track now will be what the product mix is, how the margins for DMart stand out in light of the competition that we've seen from quick commerce. And more importantly, we have a new CEO. Anshul Asawa takes over from Neville Narona. So those will be a couple of factors we'll be watching out for. Mild green on DMart is what we're seeing. On Adani Wilmar, they are in the right time for the palm oil cycle, and that's working for them. 7% volume growth, 36% revenue growth. Edible oil volume growth at 6%, revenue growth at 44%, food and FMCG segment growing at 11% as well. All boxes checked. And more importantly, after Adani has decided to sell their stake to Wilmar, they've decided to change the name of the company from Adani Wilmar to AWL Agribusiness Limited as well. So we'll keep an eye out on that. For now, good update coming in. See green on AWL.
Okay, so that's one positive number from the FMCG space coming through. Back to Abhishek. He's watching out for a couple of other names, Bandhan Bank and I think even RBL. Abhishek?
Deposit momentum has been pretty strong for Bandhan Bank. It's grown at 11.8% YOY, but 7.24% on a sequential basis, which is perhaps the second best deposit growth that you are seeing amongst lenders on a sequential basis. CASA is up 6% quarter-on-quarter. CASA ratio largely stable, you would call it, 31.4% versus 31.7% in the previous quarter. Calculation shows that the net interest margin may get impacted because CD ratio has declined to 91.2% versus 93.6%, but no taking away from the fact that deposit growth is pretty strong over here. RBL Bank, the business growth is one of the weakest that you are seeing in last 10 to 11 quarters. However, CASA ratio has improved for them. So deposits are up 7.2% YOY and about 3.9% quarter-on-quarter, one of the lowest deposit growth on a year-on-year basis that you are seeing in last 10 quarters. CASA ratio has improved for them. We are seeing this with certain lenders that CASA ratio is improving, which is a key trend to watch out in the banking sector. 34.15% CASA ratio in this quarter for RBL Bank versus 32.8% in the previous quarter. Gross advances, they are at a growth rate of 11 quarter low, coming in at 10.9% YOY and about 2.5% sequentially, which means that the stock could be under pressure. Back to you.
All right, Abhishek, thank you very much for that. Mazgaon Dock, we were talking about that earlier. Let's sort of get you the news flow here. Upasana's got that. Upasana, morning.
Good morning. Well, the stock remains in focus today as government to sell up to 5% stake in the company via OFS. Now, government currently holds 85% stake in the company and OFS includes base size of 2.8% and green shoe option of up to 2%. Now, OFS for non-retail investors will open on 4th of April, that is today, and for retail investors on 7th of April is what the company has indicated. The floor price, however, for the offer is set at 2,525 per share, which is at an 8% discount from yesterday's closing. And the total size comes up to 4,900 crore. So we'll be watching out for this OFS.
Okay, all right. Got that, Upasana. Thank you for that. With that, I think we can quickly recap our list of stocks. No, actually, we have one more before we get to the recap. Vamakshi is watching out for Angel One. Vamakshi, good morning.
Well, good morning, Surbi. Angel One has come out with a mixed update for the month of March. When we look at the gross client addition, it stood at 4.7 lakh. This is a downtick of almost 4% month on month. And this is bad because this is the third straight month where the gross client acquisition has slowed down. The client base, though, is steady at 3.1 crores, an uptick of almost 1.4% month on month. When we look at the average daily orders, they saw an uptick of almost 8%. This is after they saw a downtick of nearly 9% in the month of Feb. So that bodes well for the company. Apart from that, another positive is the average daily turnover, which stood at 36.38 lakh crores. This is an uptick of almost 23% on a month-on-month basis, and in fact, it has jumped to the highest level seen since November 2024. Keep in mind, the market share, though, has taken a hit. Equity market share is down nearly 60 basis points to 19.1%. F&O market share is also seeing a dip of almost 60 basis points to 21.5%. But the commodity market share has managed to recover after taking a hard knock in the month of Feb. Commodity market share now stands at 57.9%. So overall, a mixed update for Angel One. But in my opinion, the negatives outweigh the positives. So going with a red for this counter.
All right, the negatives outweigh the positives, but commodity is doing extremely well. Let's talk about the commodity itself. Overnight, a big decline on crude prices. How does that impact listed companies? We have Manisha joining in. Manisha, a big slide yet again.
Oh, well, absolutely. You know, as the tariffs were announced, the crude oil prices were already trading 4% down and markets were still digesting those tariffs. But the combination of an increased oil production and weak global economic outlook has put a very strong downward pressure on the oil prices. So if you look at the kind of decline that we saw yesterday, a 6% of a fall, well, this is the biggest percentage drop since August 2022. And for WTI, the biggest drop also since 2022. What the markets were also reacting to is the OPEC and allies meeting, which says that they are boosting output by 411,000 barrels. Now, this is versus the estimate of 140. So 400 versus 140 is the kind of number that the market's panicked under. And then the OPEC will also now meet on 5th of May to decide on what they want to do for the month of June. At this point in time, you're looking at higher supplies from OPEC. The U.S. inventories have surged much more than the street was anticipating. And then you have higher tariffs, lower economic growth, lower demand growth and expectations as well. And all of that has continued to weigh onto the crude oil prices. There are no buy calls as I was searching for them. It still is for the decline that the street is anticipating and for the sell calls coming in for crude at these levels as well.
Okay, all right, Manisha, got that. Let's quickly recap our list of stocks to watch. Then the ones that have positive news flow around them are HDFC Bank, Avenue Supermarts, Adani Wilmar and Bandhan Bank. Stocks with negative news flow include Bajaj Finance, L&T Finance, RBL Bank, Mazgaon Dock, Angel One, and of course there's a neutral call on OMCs going out. Take a quick break, but up next we'll have Siddharth Khemka of Motilal Oswal Financial Services joining in to get some fundamental ideas going for Friday trade.
Welcome back. You're watching us here on Bazaar Morning Call. This morning we're looking at a 110-point downtick at the open itself. Now it's accelerated a little bit to 122. Nothing really to worry about if you compare it with the rout that we saw on Wall Street overnight and the decline that we've seen generally from our peak itself. Siddharth Khemka of Motilal Oswal Financial Services joins us now. Siddharth, good morning. The banking pack has been relatively resilient, had led the outperformance yesterday as well. And we have an update coming in from HDFC Bank. What do you make of the fourth quarter update, and do you believe that the better days are ahead for that index heavyweight?
Good morning. Glad to be on the show. So I think overall banking is kind of insulated from this global volatility. That is also helping. Plus, we have the domestic liquidity measures taken by RBI, the interest rate cut cycle beginning. That is also kind of supportive to the entire banking as well as the financial services sector. To their credit, I think some of the bank business updates have come out to be very strong compared to what we were expecting, and that is also kind of helping in this environment. On its own, I think HDFC Bank, good steady numbers, and I would specifically point out to the deposits growth at 14% last few quarters. That was one area where a lot of concerns were there in terms of whether after the merger with the large balance sheet size, they will be able to get those kind of deposits, and CD ratio, how they had gone up. And with the 14% deposits growth, I think CD ratio has also declined almost 177 basis points on a sequential basis. Advances pretty steady and stable at 5.4% growth. So I think overall strong business growth, CASA ratio improved for HDFC Bank, and with the stock price remaining in a consolidative mode, I think valuations also looks good. So pretty positive on HDFC Bank from here on.
Pretty positive from HDFC Bank from here on. IT, Siddharth, the index sold off like there were special tariffs on it yesterday. The index ended 4% lower, but understandable, right? I mean, if the worry is US big time, and look at how the US market traded last night, almost as if anticipating like a sharp slowdown, even the R word. What is your sense from here? It was, by the way, not just Infi and TCS and HCL Tech, even Coforge was down 9%, Persistent was down 8-9%, index was down 4%.
So yeah, I think Prashant, while there's no first order impact on the IT space because the services have not been included in the reciprocal tariffs, I think there's a big second order impact on the tech companies, the discretionary spends, which were expected to pick up this year. And we all were hoping that in the month of Jan that this year could see an exports recovery as a key theme. Somehow that's not playing out, and there's a lot of, you can say, unclarity or no clear visibility in terms of growth from some of these key regions. What will also happen is that not only US, but some of the other regions, the developed regions, Europe, some of the other economies where Indian IT services have a big business, economic slowdown could be a big challenge, and that could lead to cuts in discretionary spending and hurt the Indian IT companies. And I think valuation for, especially for some of the mid-cap companies, the growth had been pretty strong, and hence valuations were on the higher side. Something like a Persistent, Coforge, which used to be our top pick. I think at this juncture, it definitely remains to better to stay away from IT, because clarity is not there in terms of growth. And I think post Q4 numbers, we'll see the lot of companies cutting down on their FY26 guidance. That could even hurt more when that happens.
All right, Siddharth, we'll ask you to stay on and listen into the conversation that we've lined up for you and the viewers right now. We spoke about the banking space, we spoke about IT. Let's speak about CSB Bank, the first management on the show today. The company reported a fairly strong fourth quarter business update where advances, deposits, both of them showed strong sequential growth. So to discuss this and more, we do have with us Pralay Mondal, who is the MD and CEO at CSB Bank. Thanks a lot, Mr. Mondal, for joining in. You know, I'm looking at your deposit growth, and that's the number that really stands out for me. A 24% jump year on year and a 10% jump quarter on quarter as well. That's better than all the others that we've seen in the industry. So the question is, what did you do differently, and how much of this is sustainable from here on?
Good morning, Mangalam, and thank you for having me on your show. You're right that we had a good growth, not only on deposits, but on assets, fees, everything. But of course, if you have to grow the overall balance sheet, liquidity and deposits is very important, especially in the kind of quarter we were in the last quarter, which had liquidity deficit. So we wanted to ensure that we manage the liquidity risk in terms of CD ratio, LCR, everything right. So we said that deposit is a first priority. And we ensured that all our businesses, whether it is a wholesale, SME, retail, branch banking, everywhere, we are focused on deposits, and that's the result which you're seeing today. We had a growth not only on deposits of 10% quarter on quarter and 24% year on year, but also we had a quarter on quarter good growth on CASA, which was 10%, which was very, very pleasant for all of us. Having said that, I think the big picture is that all our segments, whether it is retail, SME, wholesale, and gold, at least in my tenure, for the first time, all four verticals have done consistently well across, and almost no business has grown lesser than 20%. Every business has grown higher than 20 to 23%, and that's a very, very big positive for us, which says what I was telling all through, that now most of the verticals will consistently deliver. And hence, while gold continues to do well, but on a quarter-on-quarter basis, some of the other businesses has grown faster than the gold, and hence we'll see that our mix, at least on a basis point basis, gold can come down a little bit, though gold has also grown year on year at 35%.
So in that case, if you could give us a sense of what growth should we expect from an advances standpoint across all your verticals and overall as well. You said gold as a percentage will come down because other sectors are growing. So if you could give us a sense, say MSME, private loans, etc., at what rate will they grow? What rate would your overall book grow? And what is the expectation on gold as a whole?
Yeah, so Mangalam, we have always said that we have a vision, SBS 2030, by which by 2030 we will have wholesale 30%, retail 30%, gold 20%, and SME 20%. We are on track because we are significantly putting our technology transformation this year. This is the last year by when our entire tech stack will be in place. We are going through a core system migration, entire surround system changing, which will help us in building not only the liability franchise, but also the entire retail assets franchise. So we have now started our retail assets journey in real earnest this year, and you will see the impact of that next year. On your specific questions on assets businesses, we have seen a significant quarter-on-quarter growth on the wholesale side. SME has also done very well. Retail, we have been a little careful on the unsecured MFI in that space, and hence some of those businesses has degrown. But overall, some of the other businesses we have focused on that has grown very well. So, and gold has grown like 8% quarter-on-quarter and 35% year-on-year. So overall, I think if we need to give a forward-looking kind of understanding, we should be able to grow upwards of 25% in assets growth, and it is quite comfortable. The big question is, how do we manage the liquidity and how do we manage the deposits? Assets growth is not a problem for us.
And what does that do to your, spreads, NIMs, and credit costs? Because if your assets are growing over 25% and you are still, maintaining some sort of caution on unsecured loans, at the same time you're drumming up deposits to hold on to the liquidity that you have. What does that mean in terms of guidance, if you could give us, for your NIMs, spreads, and asset quality?
Yeah. So on NIMs, what happens is when we are primarily focusing on gold loan as a primary business, NIMs, of course, were higher. And this year we had, penal interest, which was withdrawn from a regulatory perspective. Our other business mixes are growing, which doesn't have that kind of a yield which a gold will have. And we have significantly slowed down on the unsecured side. Given all this perspective, obviously, we will come to more realistic level on the NIMs. And generally, the industries, I would say that the mid sectors or the large sector banks are somewhere around 4%. I think we will be trying to put ourselves somewhere between 4.4, 4.3 in that range. But I've always said that growth is what we're looking at. And once our tech transformation, which is a big year for us, this financial year is where we'll redefine the bank completely, moving into a complete modern system. And hence, we can do everything what other banks can do. Once we do that, I think the overall franchise concept will start delivering. On the asset quality, I think we're doing pretty well. Even last year, we are below 20 basis points on credit cost. GNP and NPA has been below 1.69%, below 60 basis points. I think, at that level, we should be able to hold on to our kind of NPA. A few basis points up and down will continue to happen, but I think we're pretty comfortable on the credit quality of the portfolio.
Right, Pralay, we'll leave it there. This year will be transformative, and we wish you all the best of luck as you continue to execute that. Appreciate it, and we'll chat again soon. Thanks very much. So that is CSB Bank with perspective there on their business. Now, the new reciprocal tariffs announced by Donald Trump risks tipping the American economy into recession and pulling the global economy down with it, says Mark Zandi, chief economist at Moody's. We spoke with him yesterday. Listen in.
Well, if the reciprocal tariffs are implemented in full, I would expect some retaliation from countries abroad. I don't think they're going to sit on their hands. So the combination of those two things will result in a recession, an economic recession. It's a tax on American consumers. The bulk of the tariff increases will fall on them. Businesses that import product will have to pay more, which will hurt their profitability and thus their investment in hiring. If I'm right about the economy and the impacts, I do think the president will ultimately react to that and hopefully will pull back and declare victory and move on. And if so, we can avoid an outright recession. But time is running out. He's going to need to pivot here pretty quickly. Otherwise, I think the U.S. economy is going to go into recession and take the entire global economy with it. I don't think any country in the world is going to get through this without some significant hit to economic growth. Some countries are going to navigate through better than others. India's got a lot of, it's a resilient economy. It's got a lot going for it. And I think, should be able to weather the storm reasonably well.
Okay, by the way, global markets are not looking any better. Most of the Asian screens are extending their declines. Australia's down 2%, Japan's down almost 2.7%, and South Korea is still down about 1%. So the picture isn't getting too much better, at least right now. We also caught up with Neelkant Mishra of Axis Capital, as well as Sameer Arora of Helios Capital, to get a sense on what these tariffs could mean for global markets and, of course, for India.
The $700 billion odd of extra revenue that on an annualized level the US will start now to collect is about 0.6% of global GDP. So this is effectively fiscal tightening for the world. The gist is that this is a straight first shot 0.6% of GDP, global GDP. The postponement of production would be another 1%. I think we are talking about a significant rise in uncertainty for financial markets. I said more than 1%. I said 1% because of investment getting delayed. That's a broad ballpark back of the envelope thing. And in addition to the 0.6% of volatility that... So India economically, I think, will be less affected. There may even be new opportunities that come up. So if Vietnam is not sort of in a hurry to bring down its tariffs, then there is a lot of apparel, footwear. India becomes relatively cheaper. I mean, there's a 20% gap between Vietnam and India. Tariffs on Vietnam versus tariffs on India. It's an advantage that can actually start to play out in our favor. I mean, it's very unlikely that footwear and apparel will start getting manufactured in the US because of these tariffs. So there may even be opportunities that come our way. But the channel through which I think the impact will be the worst will be the financial markets. So remember that people are just about starting to cope with the fact that this uncertainty will be there for a long time.
The first thing in a big picture sense, although, in our long only fund, we are fully invested and all that, but I would think this behavior of the market is a bit suspicious and not to be trusted because, Indian market has made this simple thumb rule, not that they will analyze the stock, but whether that day there is net selling or not by FIIs. See, the thing is from an economy point of view, it's not a big deal because we don't have big scale of imports and exports. You have to see if the US market goes down in a dignified manner, goes down 8-10%, we can all handle it and we will outperform it and maybe not be up in that period, but at least it will be dignified and you'll get FI flows. But if the US market is down, much more than that, then we cannot say we are isolated. That is what my lesson experience is from 2008. If these other markets go down a lot, then you can't make money. You may lose less. You may do this. Of course, in 2008, even though we had no connection with the US subprime crisis, India was down double of US.
All right, with that, we'll take a short break. Come back on the other side. We'll get you trades up for today. The setup coming in from Mitesh Thakkar and Shrikant Chauhan for a quick technical check on the market. We'll also get in some more stock ideas.
Okay, welcome back. 8 minutes to go for the pre-open session. Mitesh and Shrikant are with us with what they want you to do as far as trades are concerned. Gentlemen, great to have both of you here. Mitesh, will we see what we saw yesterday? Or it's all very confusing. Generally, that's the broader sentiment. Even if one is, will we get away with a 100-point cut, you think? Or will it be even better? Or you think it's going to be a little different? 5%, 6% sell-offs last night.
So, morning, Prashant. I think, both the Nifty and the Bank Nifty did not break the levels which would have given some kind of a reversal on the downside. Yesterday, I said 23,100 for the Nifty is the key level to watch out. We got a low of around 23,145. Similarly, on the Bank Nifty, it was 50,700, 50,800 zone. We got a low of around 50,900. But between the two, I think the chart of Bank Nifty looks much stronger compared to the Nifty. So I think today, we might, for the index again, for the Nifty again, we might open around 23,100 or 23,130 levels. If we don't see a follow through on the downside, then I think the Nifty might be stable and we might see a bounce back. Could be led by financials. It's the IT names which is worrying and which is actually keeping the index down. So my idea is that look for, buying ideas in the mid-cap space, cement space, as well as financial names, and avoid IT and the rest of the
Facing names is what you would back and more positive on the Nifty Bank than Nifty itself. We'll come back to you for immediate individual stocks. But Shrikant, would you concur with what Mitesh has to say? And what are the levels in specific that you're looking at for the Nifty and the Nifty Bank?
Good morning, Mangalam. Good morning, Prashant. Yes, the overall trend of the market is still confusing. It is not crossing the level of 23,400, but at the same time, it is sustaining above the levels of 23,150, which is something like keeping the market volatile. But in case if we see today, the market is dropping to the levels of 23,000, there we should look for taking long trades in the market. Because there I am seeing good amount of buying support, and from there again, we could see a rebound in the market. And we are doing, or we can say our markets are relatively doing much better than the other markets. So close to 23,000 levels, certainly we should look for taking some bets on indices. But otherwise, it is better to be more and more stock specific, as Mitesh said.
Okay, take your point, gentlemen. So let's talk stocks then, because the index, so we need to see what the index eventually does. What about stocks? Morning to both of you, of course. Mitesh, what's your list like?
Yeah. Good morning, Subi. On the stock side, I have more of buy calls, but they are conditional because I think the trade will be slightly choppy. So I would want to buy ACC on a mild decline, say around 1985, 1980 if you get it. Keep a stop below 1960, look for targets of 2050. CAM, similarly, I would want to buy on a breakout. So 38.45, 38.50 is the pivot level. The stock, I think, closed around 38.30 or level. So once it starts getting past 38.50, in case after the gap down it recovers well, buy here with a stop at 3800 for targets of 3960. HFCL is a buy with a stop at 81.7 for targets of 86.5. And even if you open a 50-60 point kind of gap down on Coforge, I would want to take a short with a stop about 7200 for a target of 6900.
Right. Shrikant, your stock picks?
Yeah, I think all these small size banks, they are doing well on the back of announcement on the business updates. So there we could see further more activity. And in that, we like Union Bank, which is around 130, 132 levels. If we see the overall long-term pattern of the stock, then it is showing a lot of strength. And broadly, I am of the view that the stock is heading for the levels of 150, 160 again, which was its previous all-time highest level. But yes, in the near term, we could see the levels of 140. We can keep stop loss at 126 for creating any long positions on Union Bank. And as IT stocks are finding difficulties to sustain at higher levels, in fact, most of the IT stocks have broken their important support levels yesterday. And in that, TCS has also broken its crucial support level, which was around 3,400. And based on its technical formation, now the next level to watch out for would be 3,100. So at this level, it looks weak, and there we should look for creating short positions with a stop loss at 34.75 for the target of 31.50.
Okay, got it. Thank you very much for the stock ideas. We do have to take a quick break on that note. We'll come back on the other side. We'll have the pre-opening rates, and also we will be in conversation with Digant Haria of GreenEdge Wealth. We'll put the spotlight on a lot of these Q4 BFSI updates that have been pouring in and how he's approaching the sector. Welcome back. So we'll have the pre-opening rates in the next couple of minutes. Let's go back to Siddharth Khemka for a couple of questions. Siddharth, capital market stocks in focus once again. Our colleague Vamakshi was telling us that Angel One's update, again, just the number of client additions, it's all slowed down. What's your sense? And now the market's a bit wobbly. What would you do with a stock like, say, Angel One or even BSE? BSE has gone through a huge amount of volatility on this whole weekly expiry issue.
I think should be yes. Capital markets are closely linked to the stock market direction, and with markets being that wobbly, I think the pace of new client addition that has definitely slowed down. The cash market transactions, the ADTOs that have also come down on a sequential basis. I think with the market being consolidated, these sectors will remain in a consolidation mode. From the space, I think there are two segments which looks really attractive. As you rightly asked, BSE with the regulators giving out that they would unable to move their expiries to Mondays. That was a big overhang for BSE, which has its expiry on Tuesday. And I think with the exchange giving clearly out that there can be only 2 days which would be earmarked for weekly expiries, Tuesdays and Thursdays. That definitely leaves some room for BSE to gain market share. And the other segment being the mutual fund industry, despite all this volatility in the last few quarters, we have just seen marginally dip in the number of monthly SIP data. I think that is another space which so far looks resilient. So the overall view is that the sector could remain in a consolidation mode given the market volatility. And B, within that space, we like A, BSE, and B, from the mutual fund space, we like HDFC, AMC, which has been consistently delivering in terms of profitability growth. And we also like TAMS.
All right. And what about Mazagon Dock? You know, the government is selling some stake. There is an OFS. It's likely to open lower because of the supply. But on Mazagon Dock and a lot of these defense plays, do you believe that the correction is an entry opportunity? Because orders we've seen over the last month or so pick up.
Definitely, Mangalam. I think we are structurally positive on the overall defense space. And last month of the financial year, we saw hordes of the bulk of ordering activity because the government had to reach and achieve the full year order target. So that definitely gives a lot of visibility in terms of the order book and revenue visibility for the defense players. Within the defense space, what we like the market leaders with the separate sub-segments. So within the electronics space, Bharat Electronics would be our preferred pick. We see a steady 25-30% earnings growth, valuation being very comfortable. With the aviation, we like HAL, which is again a market leader. And in the shipyards or the naval defense companies, I think Mazagon Dock has a very strong order book visibility. Valuations definitely look attractive. And we believe that in the current geopolitical environment, India stands out clearly, not only from a domestic demand, but from a global exports perspective as well. With Europe slated to increase their defense spending, a lot of the Indian defense players will benefit from the increased demand. And I think any decline would be an opportunity to buy into some of these large defense names.
Okay. All right, Siddharth, we'll leave it on that note for this morning. Thank you so much for joining in. You have a good trading session ahead. By the way, it's quiet and flat, which is very good. Even if the market decides to just do nothing and stay quiet, yesterday was a day like that. Today, also, if we can just get by with a couple of points here and there, it'll be a great thing. 4 or 5 points down on the Nifty. That's it. At a time when Asian markets are sliding between 2-2.5%. That's serious resilience. Let's see. When people like Samir were also saying, Samir Arora was yesterday telling us that there's no need to immediately go in and do something in the market. Maybe just sit out for the next couple of sessions till this settles.
Just a word on the rupee. The market may be flat, but the rupee is anything but that. It's above 85 against the dollar for the first time since December 2024. This after a time that we had seen a big rout, almost 88 on the rupee versus the dollar. And the dollar index is now down about to 101, obviously led by the strength in euro and yen. Strength in the rupee in light of that should be good, at least stem the outflow that we're seeing from the FIs in the cash market, etc. Not necessarily fundamentally good for exporters, but from a market standpoint, it is a positive. Rupee strengthening, it's just below 85.
This is absolutely staggering what's happened in the currency markets, right? This was all about making America great again. But what's happened actually is the dollar has crashed since these tariffs were announced and they were rolled out.
They want dollar down.
Exactly.
They've been saying that, well, we've paid the price for the US,
the
US dollar being the reserve currency.
So we'll punish all the currency manipulators
because
now.
Because the deficits and all of that. I mean, the dollar essentially has been too strong. So they want to push it lower. They want other currencies higher. So it's and actually in a different kind of a way it's playing out now. The broader dollar 102 now.
Okay, so that's the global picture. The Nifty is flashing some green as well, by the way, 3-4 points on the upside. Like I'm saying, if it continues like this, it will be fairly good. Let's put the spotlight on the banking space now. A lot of those banking updates have been coming in. So let's quickly run through them. A couple of broker notes as well on what we've heard from the banks at the end of fourth quarter. Abhishek.
Well, to begin with, HDFC Bank has reported its, provisional numbers with respect to business update. Sequentially, the deposit growth of nearly 5.9% is one of the best that you are seeing in the last 4 quarters. And advances growth of nearly 4% quarter-on-quarter is one of the best that you are seeing in the last 5 quarters. What's also heartening to see in their business numbers is that the CASA ratio has jumped up sequentially to 34.8% versus 34% in the previous quarter. Bajaj Finance, the AUM growth is really on the weaker side. One of the weakest growth that you are seeing in YOY in last 8 quarters, and sequentially, that is quarter-on-quarter, the loan growth rate is one of the lowest that you are seeing in last 11 quarters. So AUM growth is about 26% YOY and about 4.7% sequentially. What's also disheartening to see is that their cross-sell rate has fallen to 5.9% versus 7.2% in the previous quarter. So this cross-sell rate of 5.9% is one of the lowest in last 4 quarters and second lowest in last 15 quarters. Now we we have UBS, which has written on various banks. They have upgraded SBI to neutral. Target price has been raised to 840 per share. They said that the risk reward is balanced and sustaining the net interest margin will be the key for re-rating. So they have increased their EPS estimate anywhere between 3% to 5% over the next 2 fiscals. They expect that improved liquidity condition along with income tax rebate and 8th pay commission recommendations to boost deposit growth in the system. They have also written on Bank of Baroda. They have upgraded it to buy. Target price has been raised to 290 per share. They say that the upgrade is on stable outlook and attractive valuation. So they expect the net interest margin to witness relatively lower pressure versus peers for Bank of Baroda, and valuations are undemanding. The stock is trading at just 0.8 price to book value September 26, which is near its 5-year average. Back to you.
All right, Abhishek, thanks a lot for that. With that, we'll bring in Digant Haria, who's the founder at GreenHedge Wealth, to discuss the financial services updates that have come by. Digant, good morning. There have been a bunch of numbers, updates that have come in from this space itself. What, according to you, was the 1 or 2 things that stood out, and what is it that fell short of your expectations?
Morning, Mangalam. Good to be here. See, I think there's not much to read in the results for this quarter because see, what has been plaguing the sector for last 1 year, it has been very, very tight deposit or liquidity, so to say, and the RBI regulations were also on the tightening side. Now, somewhere in January, February, we have seen a reversal of both of these things, which is, the RBI has eased its stance in terms of regulations, and RBI is focusing on liquidity and the global events which are happening. The dollar strength is weakening, the G-Sec yields are down, the US 10-year yields are down. So all this is good for liquidity. So I think the results that you are seeing, okay, be it a Bandhan Bank or be it an RBL or be it, this Bajaj Finance, all these are indicative of a tight liquidity environment where there will be pressure on your deposit rates, cost of funds and minims. Not much to read there. I would say, from June quarter, you would start actually seeing some improvements in the numbers, both in terms of deposits and margins. So I think this is a quarter, Mangalam, where we just have to pass our time. Market has already rewarded some stocks. I think some other stocks will be rewarded in the coming 2 quarters. So, in financial sector, we'll see a good rotation happen, So, yeah, that's my opening comments, Mangalam.
Digant, morning. But when you look at, do you think banking and the general consensus opinion has been that for a long time, actually, that this is a safe place and valuations are more reasonable, etc., etc. Although along the way, we've had so many accidents as well. So I've got to navigate carefully here. But what is your perspective? I mean, as a banking analyst and you're also in a way a macro watcher as well. Will it really play out? Banks as a good investment opportunity in an absolute sense from here, Digant?
Morning, Prashant. So I think, some of it has already played out. After 2 years of underperformance, it became a safe haven, and then you saw some rally in ICICI Bank, Kotak Bank, especially at a time when markets were not at all doing well. They, in fact, corrected 10-15%. So I think some of that outperformance is already there in the price. If I look at the larger ones, which is Kotak, ICICI, a Bajaj Finance or a Chola Finance, the best of the names, it's already there. I think we will see a rotation. In the next leg, you may actually see Axis, HDFC, the Bank of Baroda's, SBI's, the PSU banks, which will take charge. But all said and done, I don't think there's more than 10-15% kind of a macro rally there in the sector. Because, the villain of this sector, so to say, is the PSU banks. PSU banks are so healthy, alive and kicking that they will not let the private sector grow beyond that 12-13% or have margins which were very high in the past. So I think this sector is, going to be a low growth, low return kind of a sector. In current markets, it's attractive because everything else, the outlook is hazy. But yeah, I don't think big money is to be made. This is a safe haven, 10-15%, and that should be it.
So, Digant, just to take that point forward, and then there is the other big debate that's been raging, right? Whether fundamentally and structurally, the whole model of banks and how they make profits, whether that's coming under question because of the whole deposit issue, right? We had Uday Kotak tweet on it saying that banks are lending at rates higher or nearly higher than their cost of funds. So in that light, is the hope of banks leading the next bull market and, large private sector banks finally outperforming, is that hope a little misplaced?
Yeah, Surabhi, I think you're right that, I think the banking sector will help the index in not falling, but I have my doubts if it can help the index in actually outperforming and starting a new bull run. And the reason for that is simple, that the PSU banks are growing as much as the sector growth. The sector is growing at 10%. PSU banks are growing at 10%. So where is the room for that 15-18% growth? See, markets get excited, the valuations get re-rated when you have 15-18% kind of growth in incomes. I think that is very, very difficult in this environment. So which is why, I say that it is a rotation market. ICICI and Kotak, the valuations have gone up. So now Axis and, SBI and, these banks, HDFC have to catch up. After that, maybe microfinance will see some cyclical recovery. Then some regional banks, once asset quality problems are sorted, then maybe RBL and, IndusInd, these banks can have some rally. But it's just like a rotation. I don't see more than 10, 15, 20% anyways in this, entire sector. So yeah,
okay.
You're right. Yeah.
Okay, Digant, your point's well taken then perhaps investors need to think about that and not get carried away with with some of those hope trades, so to speak. Now, what about NBFCs? Let's look at Bajaj Finance. Their AUM growth is about 26%. Stock has already done so well. It's the best performing stock in a difficult year so far, 2025, right? But again, do you see it really blazing the path in terms of growth? And let's not forget what the RBI said to Bajaj Finance just, I think it was yesterday, right? That letter of displeasure, quote unquote, about some of the outstanding issues on retail lending. Your thoughts?
Yeah, so Surabhi, this Bajaj Finance was a play on, the middle class, the growing consumer middle class in India. I think last 10 years, we have done a lot of penetration and, this sector is no more that nascent sector. So Bajaj Finance of today will have a lot of volatility across the way. Last decade was a clean sweep. This decade is going to be volatile. I think a lot of the improvements which will come in the next 6-12 months in the NBFC space and Bajaj Finance, it's already there in the price. There is no big money left in Bajaj Finance at the current levels. And on your broader question, Surabhi, that what about NBFCs? I think in NBFCs, we should play cyclicals. So, right now, commercial vehicle finance is at the top of the cycle, so we should not play that. But microfinance is probably at the bottom of the cycle. So somewhere in 2 quarters, microfinance may start reviving. So I think you have to play cyclicality because structurally, there is no big trade in the banks and the NBFC sector. So you just have to rotate. That's our view.
Thank you for your insights, Digant. Always a pleasure speaking with you. That's his view on the NBFC and the banking space itself. Interestingly, public sector banks won't let private sector banks grow beyond 10 to 12% was the key takeaway for me. Mitesh joins in once again. Mitesh, it's 9:13 right now. Your pre-opening call?
I'll go with the buy on ACC for Travels of 20.
And Shrikant? All right. Shrikant isn't there. So meanwhile, we'll just await the market opening. As of now, I'm just looking at a couple of stocks. In that, Zomato is the one that really stands out. I'll keep an eye out on Zomato, largely because there's a note this morning that has come in from Goldman Sachs, which says that the pessimism on Eternal is overdone. Why is that? Because after the big decline that we've seen, the current share price implies just either of the two things. One, the food delivery valuations are near zero, or secondly, Blinkit EBITDA is structurally halved. And they see both of them as, non-zero probabilities and much unlikelier scenarios. So on the back of that, the risk reward is skewed towards the upside. They have a target price of 310, which implies a near 50% upside from here itself. But despite the decline and the positive skew, the only headwind for Zomato from here on is the possibility of MSCI exclusion, because if the FDI cap comes through, the stock would be excluded from the MSCI index, and that would lead to a $1 billion outflow. So that's something that we'll most definitely have to keep an eye out on for Zomato.
Absolutely. So we'll keep an eye on this one as markets open. What do we have, in terms of a start? So the Nifty Bank is ticking higher, about 0.5% up on the Nifty Bank, 51,700 or so, I think. The Nifty is down about 1/3%. That's about 80 points lower. Nifty Bank is up 0.12, but it's in the green. I mean, yesterday as well, the Bank Nifty was the one which first turned around because the Nifty started to recover later. We have 100 points now on the Nifty. So it's a very sort of normal kind of a open. You would look at the screen. If you did not look at what happened last night in Wall Street, you wouldn't guess that 5-6% kind of cuts on Wall Street. But that's what you have. IT, I just want to take a quick look at it because the top 5-6 losers were all IT yesterday. And I can spot a few. That's a heat map. I can spot Infeed, HCL Tech, Wipro, TCS, etc. amongst losers right now. But otherwise, I mean, very few gainers, and bulk of it, of course, on the red side to begin the session. 130 lower on the Nifty. Surabhi.
Okay, let's talk about the key losers then. ONGC sliding with the 6% drop in oil prices. ONGC straight away lower, biggest loser on the Nifty right now. Hindalco is 2.5% down. Tech is still falling. Infosys, HCL Tech, TCS, all of these stocks are down between 1% to as much as 2.5%. What else? Tata Motors, again, global-facing business, 2.5% lower here as well. Maruti is lower. Bajaj Auto is lower. Eicher Motors is lower. So most of auto actually is down this morning. Beyond that, you've got Reliance, NTPC, Coal India. These are all the stocks which are down a little over 1%. Let's see what's bringing up the upside. The stocks that we were just discussing with our BFSI expert. HDFC Bank about 1.5% up. Bajaj Finance is barely there, just at the flat line. Really can't even call it a gain. And HDFC Life is also close to the flat line. Otherwise, everything else is either flat or very clearly down. ICICI Bank, most of your other banking names, not really able to support the market much. Let's look at State Bank of India, also lower. So IT and most financials keeping things under check this morning.
Keeping things under check, and the sell-off is accelerating as we speak. We opened closer to the flat line. Now we're down 120 points immediately on the Nifty. And the bigger weakness is the mid-cap end of things. We outperformed the mid-cap end yesterday, but right now the mid-cap index is down about 0.8% straight off the bat. It's the mid-cap IT names which are taking a big knock. But alongside that, we have Bharat Forge, which is lower as well. So, industries exposed to exports or overseas sales, etc. Angel One, weak client addition and lower market share is something that, the street does not like. That stock down 3%. Avenue Supermarts, again, no fireworks in the numbers, 3% SSSG. Despite the store addition, maybe the street is not very happy with the 16.6% revenue growth. They would have expected a little more. That stock lower by about 3% as well. On the way up, though, you did speak about, how the upstream oil companies were lower, but look at the oil marketing companies, HPCL, BPCL, IOC, all of them doing extremely well. Interglobe Aviation as well, uses oil as a key input, doing a lot better. For the second day running, all these textile names are surging. So we have, names like Siaram Silk Milks, Kitex Garments, all of them higher by 3 to 5%. On the way down, though, we do have Mazagon Dock, which stands out with a 6% cut on account of increased supply to OFS that has been announced. All in all, relatively worst day for the mid-cap end of things, and the Nifty now down almost 150 points. The Bank Nifty is the one which is really outperforming, and the biggest contributor to that is HDFC Bank, which is up around 1.5%.
Absolutely. So that's essentially the overall lay of land as far as specific stocks are concerned. So 0.6 lower on the Nifty. Nifty Bank is in the green, as Mangalam said, and of course, broader markets. It's too early to look at overall NSE advanced decline ratio because things are still opening up, but we'll give it some time. But maybe just put up the Nifty IT index, 4% yesterday. And by the way, earnings start next week. We'll talk, of course, about Jan to March and what the quarter looked like. But more than that, I think a bulk of the conversation will be around tariffs and what the implications, etc. Are they seeing anything? Are they hearing anything from their clients in the US? 2%, so 6% in 2 days. Well, there's a sharp hit which is coming through in that space. So
just was pointing out, Mazagon Dock down 6.5% because of the OFS. The stock immediately adjusted to the OFS price, which is 2,525 rupees. So there was that much of a discount, and that immediate adjustment has happened as we speak. And Mangalam Avenue Supermart still down about 4% I guess, despite the top line. What was looking like a decent top line growth.
Yeah, but I guess the street wanted a little more. It's no other, explanation for that apart from the fact that the street wanted a little more. You add more stores, you get eke out a positive same-store sales growth, 16.6%. That also speaks about some sort of weakness that we're seeing in urban slowdown, which still continues because this is the best barometer to track urban middle-class consumption. And if that's not growing, then maybe it's bad news for a lot of the other FMCG companies as well, which are hoping for some recovery to come by.
Dabur, how can we forget? So I'm not sure about where that recovery is. But IT and FMCG, both big sectors, and both have their own overhangs.
Yeah, absolutely. Let's welcome in Shreyas Devalkar, Head of Equity at Axis Mutual Fund. Is with us. Shreyas, good morning. Good to have you with us here. Thanks for your time. So what is the Saransh, if I can ask you that, in terms of how's the view developing between you, your team, fund managers, analysts, in terms of stocks you own? What kind of impact do you see because of these tariffs, etc., which have been announced? And it's not just day one, right? I mean, you'll have to sort of track this as you go along. But headline view first, Shreyas.
Sure. Thanks for inviting. If you look at, actually, as it is always said, that uncertainty is always the certainty, and more so in this market nowadays. In this tariff and associated impact on the companies, generally exports-oriented sector, one need to be really careful. That's what we are also looking at, because there may be some retaliation from multiple countries, there will be legal challenges, and there will be even this tariff may get reduced. Probabilities there, obviously, in this. So any action which we take now based on what is the outlook, and forget about us taking any actions based on the stock's price movement, etc. The companies as such themselves won't take actions, right? Whether it is any decision to try to shift plants or set up a plant, and this indecision, which is probably will hurt in near term. It can be indecision simply from a US company not to import today because today tariff is higher, while you don't know 15 days down the line the tariff will be lower, and those chances are there. So there's a lot of uncertainty which will have impact in numbers for company as such. That's where the bigger discussion is on where the uncertainty is low and where one can invest in from a longer term point of view. In that context, generally in over last 5 to 6 months, actually, we have increased our exposure to financial services sector, and that primarily because of the reason that it would be immune to such volatility. At the same time, we would have reduced to any export-oriented companies, may it be auto ancillary or IT sector. Today, and one more angle in this market today is about valuation, and that is very interesting. Generally, market is anchored today still, I don't know, but still I believe that market is anchored to the valuations in last 3 to 4 years. While one need to really check and recheck why and wherever the valuations are higher than pre-COVID level, one need to really justify why they are higher and whether they should be there or not. I'm not saying they should not be. Point is, one need to really think about it and check what it is and where it is, considering again the uncertainty overall in the economy and global economy as such. So these are the few thoughts which we have today now.
By the way, look at the Nifty chart and the stocks. Now it's a bit of a waterfall decline. We opened okay, and then it's just... Look at the Nifty now. Look at that graph. It's a straight line down, and everything is suddenly selling off, including pharma stocks. ONGC instantly opened 3% lower, now 6% lower. Look at a Hindalco, opened about 2% lower, now 4% lower. And even pharma is not getting spared. Look at Sun Pharma, Cipla, a lot of these names under a fair amount of pressure. Reliance itself is suddenly down 2%. So it's a complete knock. 220, and it's accelerating now. It's gathering momentum on the downside. So let's watch. Difficult morning.
Just on that point, and I think Shreyas was saying maybe 15 days later tariffs could be lower.
Kind of pull back a little bit.
But I think if you hear, and we played out that soundbite, you tossed to it, the Trump soundbite, right?
Yeah. Right.
He seemed unperturbed. He actually, if you just see what he said, after a 6% decline, he said, well, readjustment was needed. So
the operation had to be done.
It's a patient. Operation is now over, and now there is recovery, etc. So almost as if they're prepared for it.
Yeah.
And if you remember in the speech to the joint session of Congress, Trump at that point said, there was this one line. He said, there'll be short-term pain. So actually, and of course, I mean, his Treasury Secretary is a 30-year market veteran.
Yeah.
So it's very unlikely they didn't see that markets will...
But they haven't thought this through.
Yeah.
Seems they have.
So, which then means that there is no quick, going back. The bar is high, negotiation, etc. can happen. Not that it can't, but the bar is high. It's going to be tough, and they sort of dug their heels in.
So the only way to basically get to the other side is go through it and stick with the pain. I mean, the decline on the Nifty itself accelerated a little more as we broke yesterday's low. Yesterday's low was 23,145. The next 100 points came immediately. Now the 23,000 mark is psychologically extremely important. So we'll keep an eye out on that. We have a couple of technical levels as well. The 20-day and the 50-day moving average very close.
You know why? Okay, I just looked at the Asian screens. The reason why we've got this waterfall decline on the Nifty now is suddenly Asia is completely cracking. In the last, I think, half an hour, Japan has fallen 1%. It's a large market, the Japanese market. And Nikkei was about 2.5% lower at 8 o'clock in the morning. Now it's 3.5% lower. So this is big stuff. It's painful stuff. And folks, even if one has to just walk through this is not about, immediate readjustments. You don't readjust global trade lines in a matter of 2 weeks or 1 day. The supply chain realignments, it's very big stuff. And the markets, it's a new beast that the market really has to perhaps deal with post-COVID. Shreyas, hi, great to have you on the show. So in the interim, I mean, we can go to economics and we can say India doesn't get impacted that badly. But markets move on sentiment as well, right? Sentiment plays a huge part, and that's working against us right now. What should the strategy be for investors to ride this period out? Whether it lasts a week, a month, 3 months, we don't know.
True. And in that context, as I said, this uncertainty is mostly currently emanating from the global. And in this uncertainty where this tariff and the end game is not yet seen. Actually, everyone is evaluating currently the first derivative. The second and third derivative is more important, where how it affects the demand globally, and accordingly how it affects Indian companies. So as far as investors are concerned and investments are concerned, the way we are looking at it is be cautious on the exports-oriented sector. Valuations keeping aside, and as far as domestic oriented sectors, as a long only investor, one should look at more towards the domestic oriented sectors, which may be in financial services, in consumption space, as well as in the investment space.
Okay.
All right. Now, just a quick word on the IT services. I mean, it's well understood, right? US is the problem. So in India, IT is exposed 70%, 75% of the business still comes from there. So it kind of throws everything in a flux. But how are valuations here? And any views, strong views here, Shreyas? On any names or any segment here? Go on.
Definitely, yeah. So this is a very interesting sector, and this I always use as a case study for this uncertainty. If you look at the first decade of this century, this sector used to grow at closer to 15%. The second decade, it used to grow at closer to 10%, and today it is closer to 5%. And if you see, valuations are broadly there in this period. One can argue that yes, the payout companies actually stopped acquiring the way earlier they used to be acquisitive, and that's why the free cash flow generation was poor. Today, the free cash flow generation to PAT is right from 80 to 100% in the large cap, and somewhere to 60 to 100% in mid and small cap. And then the payout ratios are also higher. So that warrants somewhat the re-rating, adjusting for the slowdown in the growth. But the fact of matter is the growth is lower than earlier with increased payout ratios. So this valuation, though, may look like that yes, they have not got derated to the extent of the slowdown in the sector, but partly it is getting supported by the higher payout in the sector. So in my judgment, whenever historically we have seen that whenever there is an uncertainty, wherever there has been any potential lack of decision making by their US-based client or Euro-based client, this sector, irrespective of its valuation, has faced challenges in terms of its valuation. And in the context of this decade, the way the growth has been, one need to look at it holistically and then tread it through it cautiously, rather than going by the headline valuations per se.
Everyone's talking about relative places for safety and domestic-facing names in the light of global uncertainty. Maybe banks are one of them. Then you have the consumer space, you have the cement space, you have local infra space and defense space, etc. But one is just trying to understand whether there will be any absolute gains out here or not. Because earlier we had Digant say that, maybe because of the public sector banks outperforming, private sector banks' growth will be in check. We've seen updates coming in from the consumer space. They aren't, very satisfying. At the same time, things where there is some sort of growth, the multiples are out of whack. So what does one really do?
Yeah, that's where it is interesting point which you raised on the absolute gain, and that's where someone who is investing in the market, one should look at a relatively longer term view of 2 to 3 years at least, rather than hoping that there will be immediate gains in this, unless again all these tariff related things get changed. And as you are also highlighting, it's not likely that soon something would happen on this, and that's also opinion of multiple experts that the changes are not expected to be sooner. Even in India's case, the bilateral trade agreement is now expected over 2 to 6 months. So that is again, so whenever these countries will go through these bilateral trade agreements, you will see that more clarity will emerge in this uncertainty.
Okay, all right, Shreyas, we'll leave it on that note. Thank you very much for joining in and offering us some perspective on what's turning out to be another slightly difficult morning. The mid-cap index is also down 1.5%. It's tough to show bravado in the face of a 5-6% kind of an overnight US market decline. What's interesting is, I'm just being a little nostalgic here, I mean, in earlier periods of uncertainty or crisis, COVID, even several market routes before that, on days like these, you would always see pharma and FMCG rally. But we're in such a different market. Pharma is not rallying for its own reasons. And FMCG, Mangalam's FMCG sector, it's got a challenge of its own, right? Typically, those were your safety spots, your places to hide. But FMCG no longer is able to play that role for reasons we all know.
Yeah, but despite that, for what it's worth, if I may, Tata Consumer is still among the top Nifty gainers right now. Britannia is mildly in the green. And we have HUL, which is recovering from the lows, as is Nestle. But there is no growth out here. So you just keep an eye out on how that pans out. But from extreme defensive domestic, let's go across to the one which is on the offensive right now, the way down, the IT sector. IT Rima is everything that FMCG isn't, apart from the fact that the only thing that is common is the underperformance that we're seeing for both of them.
Indeed. So let me just quickly run you through what brokerages are saying now. First, Bernstein says the impact on Indian IT over the near term will be uncertainty in terms of tech budgets and spending. So their expectation is tech budgets will get pushed out further, and that will drive lower growth. The worst case scenario is that a global financial crisis, way back in 2008 kind of a scenario, when the global world, slipped into a deep recession. And at that time, Indian companies had reported a 10% quarter-on-quarter revenue growth. TCS was down 6%, in terms of a revenue growth sequentially in Q4 of calendar year 2028. Accenture was down 13% in terms of a top-line growth. Now, Bernstein is saying that that's not the scenario that they're anticipating, a GFC kind of a scenario, but they do anticipate that growth rates will get impacted. So they prefer quality. Their bet lies with Infosys in the large cap space and high growth mid cap companies like Coforge and Persistent. They're underweight auto ER&D companies like LTTS and Tata Elxsi. Now, JP Morgan is saying that when can the stocks potentially bottom out? The bear case scenario for them is that there is no growth for large cap IT names like Infosys, TCS, HCL Tech in FY26 and no margin expansion. If that is the case, then we're staring at deep EPS cuts for FY27. And if you apply the bottom PE multiple, then you're still looking at downsides of 7% for TCS, 6% for Infosys, and 14% for HCL Tech. For mid-caps like Coforge and Persistent, etc., and some of the others, we can potentially, in a bear case scenario, right, that is no growth. In FY26, we could see EPS cuts of 10 to 15%, and then there could be downsides of 13% for Coforge and 25% for Persistent. So their recommendation is stay light on IT, don't buy into any stocks in the earnings season. A conservative guidance commentary from IT companies could drive stock prices lower, and that perhaps could throw up an opportunity. So they like Infosys and some of the growth mid-caps. Macquarie, on the other hand, believes that the current market reaction is overdone, and if you have a long-term time horizon, then this is an opportunity to load up on the stocks. Back to you.
Yeah, but you'll have to have nerves of steel and a stomach to, to withstand that whole volatility, digest that volatility, if you want to be that braveheart buying IT. on days like these. Thank you very much, Rima, for bringing us the street view. Sector definitely under pressure. Let's move on to our next corporate conversation then. Bajaj Auto is the company that we have on our radar now. The stock, like the rest of the market, has been under a little bit of pressure, down about 2% this morning. The monthly sales numbers came out and they were more or less in line. March sales data coming in. Domestic sales were quite flat. Exports saw a small 2% growth. We have with us Mr. Rakesh Sharma, Executive Director of the company. Mr. Sharma, always a pleasure to have you with us on our morning show. Thank you for joining in. I'll talk about the domestic sales in a bit, but I mean, as an industry veteran, let me ask you the bigger question. I mean, this whole tariff storm that's blowing out. I remember when we spoke about this earlier, of course, you're not that impacted. Your big export markets are Nigeria, Africa, Latin America. But as you watch this from the sidelines, are there any second or third order, perhaps, impacts that you would be wary of?
Good morning, Surabhi. Yes, indeed, you know, the world order equilibrium has been disturbed, and a lot of us who took globalization as an irreversible phenomena are now seeing the winding down of that. While we are not impacted directly, but you know, these kind of uncertainties lead to the weaker currencies moving, getting devalued, leading to retail inflation, and could sort of dampen demand. There are countries like Mexico. Mexico is one of our largest overseas markets, both by volume and value terms, and how the economy of Mexico is impacted. We have to see once all these tariff, the dust around the tariff wars sort of settles down. So there is no direct impact, but yes, like you said, there are secondary impacts to be watched out for.
So what is your exposure to Mexico in terms of your total export pie? What does Mexico contribute?
I won't call it exposure. It is a substantial, like I said, it's one of our top 3 markets. I would say we do about 10,000 units per month of very high-end products. So we have to see, till now there is no major impact in terms of demand, and growth rates are sort of almost similar. But going forward, we just have to be watchful as to how the economy of Mexico gets impacted.
So just to complete this point on global trade negotiations and pressure, now, whenever Mr. Trump speaks, he loves to talk about motorcycles, right? We've all seen that. And India has had to respond by lowering some duties so that those Harleys can ride into India. Could that, going forward, if we are willing to give more, could that become a challenge for your super premium bikes? I mean, KTM, the super premium brands that you're selling here in India and overseas as well?
Not at all. See, we are already competing with US brands and Chinese brands and Japanese brands in over 108 countries, right? So if we are competitive overseas, we will be competitive in India. So quite frankly, this is not a great issue for us because even if we lower duties or bring them in line with the US, we would in fact require reciprocity. And in any case, our exports from India to, that is Bajaj Auto's exports from India to the US are very small. And, you know, only the KTM and the Triumph joint products, which we have co-developed and are manufactured in India, they go over there. They constitute about 1 to 2% of our entire exports. So even from that point of view, it's a very minimal impact. But from the point of view of lowering import duties in India, I think we will be competitive.
Mr. Sharma, we'd ask you to just hold on for 20 seconds before we come back and speak about the domestic markets as well. Because it's that kind of market where you look at Twitter before ticker. Donald Trump has now put out on
Where
pharma,
is this, Mangalam? Is this
we're just trying to figure out, is it on social media? Is it on Truth Social? Is it on a statement, etc.? But what we know is that pharma tariffs will be coming soon. And he said, and I quote what is being flashed, pharma tariffs will be at a level you haven't seen before. And to add to that, he said that they will be viewed as a separate category. Now, yesterday, the only sector that outperformed was the pharmaceutical sector, expecting some sort of relief because, you know, for the sector on the whole, along with a few other, they were excluded from these tariffs that were announced. He said it will come in the near future, not too far. And now the fear of that comes back once again. I wonder what the hedge fund guys would be doing, you know, yesterday with the outperformance that we saw, with now the underperformance that we're seeing. A couple of these stocks which have high exposure to the US markets, Aurobindo Pharma, etc. in particular, Zydus Life is the other one, all of them at the low point of trade, and that's the one which is now causing some fear.
Mangalam, that's what I was saying yesterday, right? I mean, that tariffs exempted for now. For now. But that was because, he's talked about pharma so many times to suddenly think that he'll now not do it, especially after what he did on tariffs, which was much more severe. So, I mean, generally the sense was that it'll come. And the executive order specifically said this is national security. He said, why does he want pharma tariffs? Because he wants pharma, he wants these things to be made onshore in the US.
In America.
So I think that perhaps is the reason why you have this now coming through. It's a soundbite. It's an interview, I was saying. It's an interview to Sky News, we are being told, which has happened now. Or maybe later it's being aired, and we'll play that specific soundbite out for you in a specific, in shortly. But these are... I mean, ignore the rhetoric at a level you haven't seen before, but maybe not, right? Because he's done what he said he will. But the tariffs are going to come. What we'll do also, of course, is revisit this space with Vinny, because she had some exposure details, etc. That table, very helpful company-wise exposure to the US market. So that coming up in just a bit.
I think in line of that, the only thing that the market's taken cue from here is that the two things that Donald Trump can't impose any tariffs on are the Indian banks and the Indian consumer stocks or the Indian telecom space as well.
That's true.
Because that's where you have a bunch of flows coming in immediately. Up until yesterday, we were like, okay, maybe there is some relief with pharma. It's not included immediately. Maybe sometime later. For now. But as soon as that news came by, we had a swift move of capital towards the domestic consumption names itself. We have HDFC Bank, which is zoomed in, and all the other FMCG stocks that Surabhi was talking about have now moved into the green as well. Not Vodafone Idea, but looking at the Nifty FMCG index and HDFC Bank. So the Nifty now holding closer to that 23,100 mark versus the 23,000 mark itself. But let's go back to our conversation with Mr. Sharma of Bajaj Auto. Mr. Sharma, with all that is happening around the world, it is easier to talk about and discuss economics. But from a business standpoint, both globally, growth has been lacking at a lower base but a higher rate. But domestically, you had guided for a 6 to 8% sort of growth, and you've ended up doing just 2%. So when we stand at the start of FY26, what is your target for the next year when it comes to domestic volume growth and export volume growth for the next year?
Yeah, well, I would say that the outlook for the industry, which we are presuming, is about similar as what we had said last year, about 6%. But the important thing to understand is that the nature of growth is not completely linear and completely secular. You will have quarters which will be very, very high growth, and you will have quarters which will be very, very low growth. And as we move forward, you see these differences between growth rates and the actual performance, between outlook and actual performance, there is a constant dynamic over there to manage, which is between growth and profitability. Because growth is just one dimension of the market. The other dimension of the market is competitive nature, the inflation. And as you know, at Bajaj Auto, we are constantly trying to optimize both the top line performance and the bottom line performance with market share and competitive position. So a lot of these variances which you see is trying to get what we feel from our corporate standpoint is the best competitive position, which is a competitive position comprising of not just a volumetric position, but a value position and a certain profitability profile. And we will continue to do that. And we think that through its ups and downs, next year the motorcycle industry should be looking at a 5 to 6% growth.
And what about you?
Well, we would like to outpace that, and particularly in the top half of the industry, which is the 125cc plus industry, we would be planning to, grow beyond what the industry is going to presumably grow at.
All right, Mr. Sharma, thank you very much, sir. Pleasure speaking with you, and we'll sort of continue this discussion, fast-moving environment, more so on a global level. So, that discussion on autos, etc., will continue. We'll take a quick commercial break here. We've got a discussion on apparels coming up. We've got a discussion on the EMS space coming up as well. You'll hear from Gokuldas Exports and PG Electroplast coming up. Welcome back. We have the management of Gokuldas Exports joining us. Seva Ramakrishnan Ganapati is Vice Chairman and Managing Director at Gokuldas Exports joining us. Mr. Ganapati, good morning. Prashant here. Yesterday your stock was up 7-8%. I mean, leave the stock aside, but that's just an indication. Market assumption is tariffs here are going up. They're going much higher in places like Vietnam, Cambodia, where a lot of the China manufacturing moved after the first round of tariffs. So maybe there was some shift to India. Is that really the case?
So it's early days, so we need to see how all of this pans out. Relatively speaking, we are better off compared to other competing countries. Take China, Vietnam, Bangladesh, Indonesia, all of these countries, so we're better off. However, apparel already attracts tariff from 15 to 30%. Now, the new reciprocal tariff, which ranges from 26% for India to 54% for China, are all in addition. Such a high tariff could impact consumer demand as increased costs eventually will be pushed onto the customers. So, of course, this will happen with a phase lag. We will have to see how all of this out and, how does this impact volumes going forward. So that's something which we will have to wait and see, as to the impact of some of the tariff on some of these areas.
What is the tariff US charges right now so far on Indian apparel imports?
So on all apparel imports, US charges anywhere between 15 to 30%, 32%, currently, depending on the product type.
15 to 32%. And what is, for your products, what is it on an average?
So on an average, it would be about 17% or thereabouts in that ballpark.
17.
Yeah, that's right.
And what percentage of what you produce goes to the US?
Goes to the US? It's about 70%.
So 70% of what your revenues are tariffed at 17% right now.
That's correct.
And they will be now, from the 9th of April, the 17 plus 26.
That is correct.
I mean, not 26. It'll differ based on... No, it'll be 26, right?
That is correct. The 26 is a flat, increment. Rate. And then depending on the product, the base tariff will change.
Now, what are the tariffs? What are the cumulative tariffs on Vietnam, Cambodia, China? After this, you must have looked at it. Yeah, the new ones.
Against our 26, for China it is 54%. I think it is some 45 or odd percent, 46%. Bangladesh it is some 13%. So 37% against our 26%. So Bangladesh will be +9, Vietnam, there you have, So all of these are...
No, Mr. Ganapati, our tariffs, for example, if you take Gokuldas as a proxy for the industry, will be 43%, right? Total 43% tariff.
That is correct.
17 plus 26.
As in the base tariff plus 26, right?
Correct. What is that same number? Existing tariff, because those countries would also charge some tariff, right? On apparel exports to the US.
No. Their base tariff...
Yeah.
So their base tariff remains the same, anywhere from 15 to 32%, depending on what product you export. So China, since they export more synthetic garments, their base tariff will be even higher because synthetics attract anywhere between 25 to 30%. So let's say their average is something like 20%. So on 20%, there's another 54%, so that goes up to about 74%. For China.
Okay, so the delta between our 43 and where they are is how much, roughly, between these three? These are the three important ones. Bangladesh, Vietnam, and
Yeah. So when you look at the delta, everything depends on the product type. So remove the base tariff. If you look at our 26, Bangladesh is 37. The delta is 9%. Look at our 26. Take China at 54. 26 to 54. That is the delta that we are talking about. That's about 28%. And with Vietnam, it will be about 20% or thereabouts, 19%.
Okay.
That's the tariff delta.
20% tariff delta. I mean, we are cheaper by, just tariff-wise, we're cheaper by 20%. The other...
Approximately,
the cost of output, is it... Can that kind of take care of this difference or no? I mean, now in terms of competitiveness,
no, this is
just
huge.
pure competitiveness.
This is huge. A 20% delta and so on and so forth are very large. It's very difficult to manage it through cost management and all of that. So cost of raw materials, etc., will not offset all of this. This tariff delta is advantage India. But then I think what we really need to keep in mind is that what is the impact of all of this on end user demand? Because all of this looks great on paper. We have to see how does this impact consumer demand in the United States, which is a very large market. And if this tariff actually will get passed on to the customers, will they buy in the volumes that they will they have been used to buying, right? So that is something we need to see. So and if that volume drops, of course India will still tend to keep a good share of the volume, so there is a benefit for us. But any drop in volumes does impact the industry as a whole, right?
And we don't know, just purely with regards to tariffs, we don't know how these countries will give in, cut tariffs and try to negotiate deals, etc. Right? That tariff differential may change. We don't know, depending on what everybody does. I just want to make a quick mention, Mr. Ganpati, just coming to you. There's a flash at the bottom of the screen. There was this confusion, then it was confirmed, because the board which President Tariff had, when he announced the tariffs, mentioned Indian tariffs at 26%, but then the website said 27%. So the understanding by the end of the day yesterday was that the actual tariff which US will charge on Indian imports is 27. Now what we're saying is that the Annex 1 on the White House website mentions 26% tariff. So basically...
The president can't be wrong. It's as simple as that. Yeah. So he was holding a placard which said 26.
Yeah.
The next year on the website said 27. By the end of it, the placard is right.
Correct.
So it's 26.
So, it is 26, not 27. Just
that doesn't make much of a...
Yeah, it doesn't make much. It's a technical thing, but I mean, it is what it is. Mr. Ganpati, two questions. One, have you heard, it's very, very early, but have you heard, because the underlying consumer demand in the US, just look at the stock market yesterday, right? Have you heard from big clients, and you supply to most of them? Gap and Victoria's Secret, and I don't know what. There are so many other big brands. Have you heard anything from them from after what we've seen in terms of tariffs?
See, everybody is trying to assess what the impact will be, because every brand has worked out certain scenarios of tariff, and this tariff has been way out of the range of the scenarios that they had worked out. So nobody has absolute clarity on which way the consumer demand will go. So it will take a few days for them to react. But the tariff quantum being so high, they will have to really strategize as to how do they deal with it. These quantums cannot be pushed back to the suppliers, because no supplier can bear this kind, nor can the retailer bear this. So eventually it will have to be passed on to the customers.
But have order cancellations started? There is some feedback from the Indian Apparel Association that they're asking for, importers are asking for discounts.
No, not yet. It's too early.
That's not happened. So, you've not seen that?
No. We have not seen that.
Sorry, you were saying, you were adding something.
What I was saying is that, look, at the moment, summer products are already in the warehouses in the United States or are in transit. Now, those will enter at the previous tariff, tariff rates. So the consumer impact will start from fall winter, which is still quite some way off. So we are talking of something like September onwards, because the tariff will impact the incremental goods which are now going from April onwards. So the impact of tariff will come with a phase lag. In the meanwhile, my sense is that many countries will continue negotiations with the US government, and we may see a change to all the
Mr.
tariff tables
Ganpati,
that we are looking at.
No, absolutely, Mr. Ganpati. Every day is a new day. Every day these numbers are changing. But as of now, if you work with 26%, how much of it will have to be passed on to the US customer? And therefore, what is your realistic assessment right now in terms of a drop in demand?
So very hard to say, very, very hard to say. So, consumer demand is price elastic, right? And will all of the 26 be passed on to the customer? I think a large chunk of it will have to be, because rest of the value chain cannot absorb this. And keep in mind, India, only India is slapped with 26, right? Other countries are even higher. So their imports from Vietnam and China are far, far higher than that of India. So on an average, the impact on US imports will be closer to 30%, 32%, or even 35%. So we got to see whether, such high tariffs can be passed, can be absorbed by the value chain. Unlikely. So it will get passed on to the customer. Now, whether the customers will react by buying less, what other ameliorating measures are there in the US, which, allows consumers to come and buy more, all of that will have to be seen in conjunction. And we have time. We have time for about 3-4 months before all of this kicks in, because, we're talking of goods which will attract tariff and be consumed by customers down the line, not right away.
We take that point entirely, and obviously when things start to look like they're settling, we'll also have the question of whether India can benefit from this by virtue of its own capacity, by its own capabilities, etc. or not. Players like you will obviously outperform, but maybe a large amount of fringe players may not get the similar benefit as one is expecting. But I guess that is a conversation that we'll have at a lot later time. Thank you so much for joining in and giving us your perspective on this one. But meanwhile, while we were having that conversation, we had the commentary coming in from Donald Trump on pharmaceutical space. Now we have the video bite as well. Donald Trump saying that pharma tariffs will be starting to come in soon. Let's hear it out from Donald Trump himself.
The pharma is going to be starting to come in, I think, at a level that you haven't really seen before. We are looking at pharma right now, pharmaceuticals as a separate category, and we'll be announcing that sometime in the near future, not too distant future.
All right, so that is Donald Trump saying it as is on the pharmaceutical space, and that's the one that actually spooked the entire pharma stocks as well. And now as we speak, a lot of them are at the lower end of today's trading range. Divi's Labs and Cipla, for instance, down about 5%, and a big gash is what we're seeing on Sun Pharma and Dr. Reddy's as well. So,
by the way, that's yesterday to today, and this is the discrepancy, because when the US president held up that placard, and also this was posted widely on social media handles, India's tariff was 26%. But what happened was that when the annexure came out on the official US website, India was getting a 27% tariff levy. And we did check this back with a lot of specific US government officials here in India and overseas as well. And it seemed to appear that 27%, the official number from the website, was the number. But now that US website has changed the number from 27% to 26%. So as they say, perhaps the president cannot be wrong. He said 26, so 26 it really is.
26 versus 27.
It doesn't really.
Yeah, it is what it is. What's really, spoken the street right now is the Nifty is on the verge of breaking that 23,000 mark as well. So that's the important number.
It has, in fact.
It's broken the 23,000 mark, I think, for the first time in the last 2 weeks or so after it conquered it. Let's speak about the impact of that on, could there be any sort of, problems coming in for a lot of these electronics makers? We have PG Electroplast joining in. Obviously, the thesis here for all these electronics makers is manufacturing in India for India, import substitution. So to that extent, not a lot of these players have any export sort of exposure. And add to that, the government recently approved the electronic component PLI of 23,000 crore rupees as well. Kotak in its recent note did say that this will aid backward integration. To what extent and what could the impact of the global noise be on businesses like PG Electroplast? We have Vikas Gupta, the managing director, joining in. Vikas, first up on the exports issue. I presume that you have zero exposure to exports, but in light of higher US tariffs, do you think the electronics industry in India could get impacted? That's point number one. And secondly, what kind of benefits do you expect from the cabinet approval of electronics component manufacturing scheme of close to 23,000 crores? How does that aid things for people like you?
So good morning, Mangalam. Basically, when we look at the exports for our company particularly, right now our exports are almost negligible. And if we talk about particularly about the US market, our exports are actually nil. So we do not see any impact on our company for the tariffs that has been announced by President Trump. Regarding the overall industry, I think industry might gain in a longer run with these tariffs coming in, because the differential of the tariff between the Vietnamese and the Chinese origin goods vis-a-vis with the Indian origin goods is it's quite large. It provides an opportunity for arbitrage, but we have to see how it will play out, because everybody, all the governments will be trying to negotiate with the US government to look at the lower tariffs. So we don't know how it will play out. So we have to wait and see how it goes. Regarding the electronic component,
Mr. Gupta,
please,
we'll come to the PLI scheme in just a minute. I just have one or two additional questions to complete the export picture first. Understand that you don't have exposure, and I mean, I'm sure you're feeling very relieved in an environment like this. But otherwise, electronics exports is the sort of the big effort for India to sort of take it forward, particularly in products like mobile phones, right? Would you have a sense? I know it's a bit of an unfair question. It's a better question to be put to the industry association. But when we talk about the total electronics industry, would you have a sense of how much our exposure would be to the US right now? I mean, a lot of people are setting up big capacities. iPhones, for instance, I mean, from Foxconn to the Tatas, there's serious investment that's gone into it.
So, Surbhi, for me, I do not have the exact numbers, but largely what I can see, India is aspiring, and the players in the Indian electronic EMS space are aspiring to set up a large capacities and ramp up our exports, particularly for the mobile phones to the US markets. And it has actually happened in last 4 or 5 years. If you see the exports have grown multifold for the mobile phones from the Indian companies. So going forward, I think once the dust settles down on that this tariff issue, maybe I think still there will be advantage for Indian companies to look at.
Yeah, but right now we have to deal with this 26% additional tariff. The PLI scheme, now just to connect back to the other question, the PLI scheme that finally got announced, 25,000 crores, I think is the total value. Now that is entirely for domestic markets, or is there a sort of a portion of that also incentivizes making electronics for exports?
So, Surbhi, the broad draft of the policy and the articles that I have read, I've gone through. As per that, basically the focus for this electronic components manufacturing scheme is to deepen the component ecosystem in the country. And there are key electronic components for which we are still dependent on overseas vendors. That is basically the idea from the government side, to see how we can develop the component ecosystem for those key components in India. And I think the Indian companies will have to become the part of the global supply chains, global value chains, to participate in those critical components.
And what does this do to players like you in particular? Are you having any backward integration plans right now for yourself? If yes, then, how does this scheme aid your margins?
So, Mangalam, right now, if you look at for our company, particularly the electronics is a very small part of our overall revenue business.
Right.
Regarding the backward integration, we are in talks for the component backward integration in our appliances category. Regarding the electronic components manufacturing scheme, definitely we are evaluating this, and we are, in fact, we are actively will be pursuing the opportunities in this space also. And going forward, as and when the policy comes out, the detailed policy comes out, we might be participating in this policy as well.
What would your exposure to electronics be according to you? And with the backward integration that you're thinking for appliances, how much would that aid your margins by?
So regarding the electronics business, right now, it is not even 10% for us in our overall revenue scheme. And we have aspirations and ambitions to grow that electronic business vertical as well. So we'll be pursuing the electronic components manufacturing scheme. Regarding our backward integration in our appliance category, we have already announced our intention to get into the air conditioning compressor manufacturing, and we are in active talks for that. So hopefully we'll be able to close that agreement within 3-4 weeks' time.
And how much money are you looking to put to work for both of these, for the component manufacturing, compressors specifically, which directly ties in with your business, gives you better backward integration? How much for that? And how much for this new electronics vertical?
So for the compressor manufacturing, we have already earmarked capex of almost around 350 crores. So that is already earmarked. Regarding the electronic component manufacturing scheme, so there are different components requiring the different amount of capex. So we have to evaluate, and it will be too early for me to commit on the capex amount in that scheme.
All right, and this 350 crore yields what kind of improvement in cost and margins?
So, Mangalam, if you look at the compressor plant that we are planning to put up, that will be largely margin accretive because almost 50% of that compressors we will be using for in-house consumption for making of air conditioners, and balance 50% will be sold to the outside customers. So if you look at the revenue side, we are looking at asset turns of almost around 4 to 5 in that with a capex of 350 crores. But out of that, almost 50% will be consumed in-house.
Okay, all right, got it. And the timeline for commissioning, I'm guessing it will take at least 2 years plus, right?
So, Surbhi, our target is that in the calendar year of 2026, maybe in the second half of 2026, we should be able to start the production on that.
Oh, okay. That would be fairly quick. Got that?
I just, since we have you with us in the interim, I would like to know your thoughts on demand for this summer, because I remember this very interesting conversation that we had with you and, Mr. Tyagarajan of Blue Star as well, saying that if AC demand grows beyond 25 to 30%, there could be a bit of a supply issue. Has that happened so far? We're just a couple of weeks away from summer, so I presume a lot of these orders for your clients would have been made already.
So, Mangalam, I would say still, we talked only maybe 2 weeks back. So still the market is hoping for a good summer. And I think if you look at the trend for last 15, 20 days, the heat wave has picked up across different parts of the country. And we are seeing a very robust demand. And we are keeping our fingers crossed. Let us see how it plays out. For us as a PG Electricals, let me clearly state here that we are adequately covered to take care of the demand for the months of April, May, and June. So for our side, there is no trouble. But definitely some industry players might face some kind of shortage of compressors if the demand picks up beyond the 20-25% target.
As of now, all signs are that it will be 20-25% itself, and perhaps not beyond that.
I'll say it's too early, but the sales are looking quite good. I would say it can be more than 20-25%.
All right, got it, Mr. Gupta. We'll leave it on that note. Thank you very much for joining in. Appreciate your viewpoint. That's PG Electroclass. By the way, look at markets. It's serious pressure across Asia, and we've not been spared in the global storm either. The Nifty is down 275 points, but this is still the best-looking screen across Asia. Singapore, a market like Singapore now is down 3%. Japan is down almost 4%. South Korea is down about 2%. So all the markets from where we started at 8 a.m., they have doubled down, in terms of the decline. That's the extent of the fall after a serious drubbing yesterday as well. Tough Friday. Let's take a break. We'll come back on the other side and figure out how the commodity markets are coping with the Trump impact.
Welcome back. Let's shift focus to the commodity space. Manisha, what is it that you're tracking today? It's been a steep sell-off across the board overnight.
Yes, and the pain is that it doesn't stop there, does it? Because all the time zones yesterday saw very sharp declines, whether it was currencies, the dollar index, which has declined quite sharply as well, and all commodities trading at multi-week or multi-month lows there. But I'm keeping my focus on the crude oil prices because the declines here have been the sharpest. 6% of a decline in the overnight markets, and that has been the biggest single-day decline since July 2022. That's how bad that the crude markets have taken it. If you look at this week itself, we are down by 4.5%. And if you look at the prices in the last last 1 month, they are down by 7%. And in the last 12 months, the crude oil prices have gone negative by 24%. So good for the consuming countries. Let me tell you that 80% of global countries actually import crude. For those countries, this price decline actually is quite positive there. Let's look at the reasons why we have seen such sharp decline come in for the crude oil prices. Well, to begin with, the US has put tariffs of anywhere between 10 to 49% on trading partners. You know, that's the other thing about international commodities. These are global commodities in nature. And when you see specific countries putting tariffs there, it does disrupt the overall international market there. And that's exactly what is happening with the crude prices also. Apart from that, there also are concerns that these tariffs could lead to weak global economic growth going forward. And that would mean weaker crude demand going forward as well in sense of fuel. In any case, with the kind of renewables investment and energy transition that we have been seeing, we have seen some pressure come in for crude, but this just adds more to that. Apart from that, the US crude inventory is also gained up by 6.2 million barrels versus a forecast of a decline of 2 million barrels. So this was a big surprise coming in for the markets. And then it also has been about the OPEC and allies meeting, which was yesterday. They also have speeded up the output hike going forward for the month of May there. If you look at the numbers, well, the street was working with a number of 140,000 barrels per day of an increase. What OPEC and allies gave you was 411,000 barrels per day. So this is 3 times more than what the street was anticipating. So when you look at OPEC and allies, there are 8 countries who actually have agreed to that. And these are inclusive of Russia, Saudi Arabia, UAE, Kuwait, etc. What the markets are also looking forward to now is the OPEC and allies meeting. The next one happens on the 5th of May. That will tell you on what is anticipated for the month of June. But very closely for today, it is going to be the US non-farm payroll data. Well, the further cues would come in from that.
Okay, all right, Manisha, got it. Thank you very much for that. And with that, we have to take a very quick break, come back on the other side, and it'll be time for a special segment. It's the it'll be the Citizens Monetary Policy Committee. Lata will be in conversation with experts to discuss whether the RBI will cut repo rates and boost liquidity in the monetary policy. That's all set for next week.